Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the quarterly premium plan webinar. Today's date is July 7 of 2020, and today I'll be going over lots of different aspects of our premium plan, specializing in the algorithmic trading signals and trade management signals that go out on a nightly basis to premium plan subscribers, but that doesn't have to be everything we cover today. There's always interesting things going on in the market, and we can do a Q&A later. So save up your questions, and I'll try to answer as many as I can during our approximate 1 hour long webinar. So let me bring over the disclaimer. It's at my website, elliottwaveplus.com. You scroll all the way to the bottom of any page, and you click on this Terms of Service Disclaimer tab, and there it is. It's there all the time. Please be aware of it. Go there and read that, please. And if I were to summarize it in one sentence, it would be, there's a risk of loss in all trading. Another important aspect to the disclaimer that I want to make a special note of when I'm talking about the automated trading signals is that past results are not a guarantee of future results. Okay, so let's get straight to a few charts. I wanted to start this week, or this quarter, with, and I'm going to turn off the video of myself so it doesn't take up any room on the screen. I'll turn the video back on toward the end. The premium plan trade signals have a good history of producing solid, profitable signals over the almost 3 years we've been doing them here now. And but this last quarter has been challenging, and the reason has been the VIX. And so if you'll notice that this is a chart of the VIX, and right here is the February of February 19 of 2020 all-time high in the S&P, which still stands. And there was, of course, an explosion of the VIX higher during the 38, or actually 35% correction. Yes, Slava, there will be a recording of this webinar for everyone to see, and I'll post it at my blog, and so everyone in the entire world will be able to see it, no matter if they're a subscriber or not. But that's a good question. Thanks for asking it early. Get that one out of the way. So the VIX exploded higher while the S&P was dropping 35.5% in just a matter of a few weeks. And then what many people believe, and I'm going to show a couple of things that kind of go against the mainstream belief, is that the Fed stepped in and they've been backstopping this market ever since, and that caused the VIX to run right all the way back down to the 200-day moving average, which is this line right here. Notice that the slope of the 200-day moving average on the VIX is green. That means that it is trending higher, and that the VIX during a normal stock market, where the stock market is generally in an uptrend, has a tendency to bob along a bottom kind of basing process the occasional pullback in the market creates a little bit of a spike in the VIX, not that much. And you can see that the 200-day moving average on the VIX moves from green, which means it's sloping to the upside, to red, which is sloping to the downside, and it cuts through the price action, through the middle of the price action during all of the basing. Well, that all changed dramatically there in February. And now we have the VIX returning back to the 200-day moving average, but look how high the VIX actually is here and has stayed during this rally since mid-March. So it really has stayed above the VIX peaks that occurred in May of 2019, August of 2019, and October of 2019. And it's above those levels now. And so it seems to have found support at the 200-day moving average twice now. And I think this is important because the VIX, I think, is telling us an important story. It did not drop all the way back to its normal baseline of everything's cool. And the higher VIX that had stayed above what would have been considered a normal range for the VIX has caused the average daily range of to be relatively high. In even during the big rebound that we've seen in the stock market. So I'm going to move to an actual algo screenshot. And for those of you that have been on the premium plan for a number of months, you'll know that prior to the recent re-optimization of all of the algos were getting stopped out a lot while trying to auto trade this market. And a really good example is can be found at the website under the blog. So you go to the website and you look at resources blog, and exciting new improvements to our algo trade signals for subscribers, and you'll see a comparison chart of the algo on this is prior to the optimization that we just did. We've been feverishly re-optimizing these algos, and you can see that there weren't any big winners during this move up since that March low on the Dow Jones Industrial Average, but after it was able to incorporate that price action into its 3-year running back test, it started working with a larger stop. So the stop previously was 1,100 for longs, 1,500 for shorts. And now the stops are set at 2,100 for longs, 1,600 for shorts. So there's definitely a larger stop for daily trading on the YM contract, and by making it a larger stop, it was able to put in a couple of nice winners. 2 big winners since the March low, and notice there's still a couple of some losing trades. So here's a small one that you can't hardly see here, another one here, and another one right here. The way we designed the algo was not to give the best winning percentage, because what we found was that if we're hunting for a huge winning percentage, the algo doesn't make very much money over time. And so the way we designed the algo was that every time there was a fairly substantial kind of breakout in momentum, or it looked like momentum was going to be established in a particular direction, and that includes to the downside direction here and here, and both of those winners were basically the same. So the changing of the sides of the stops really didn't affect the performance quality of the algo prior to the March low. It's only moving forward from the March low as we're in a generally higher VIX environment, larger whipsaws. And so what the algo does is whenever there's enough momentum built up, it assumes that this might be a breakout. It assumes it might be a breakout, knowing, based on back testing, that it only has about a 50% chance of being a breakout. And so with back testing, what we do is we are able to control the size of the losses and keep them small. But because the algo has an open profit objective, it is possible to get these huge winners. This is the huge difference maker. If we wanted to set this thing so that it had a real high winning percentage, then we would ask for it to take profits pretty quickly at a fixed, amount of profit. Well, that would cap, what if it took profits like right here and it was only 1/3 of the way through the move? So we designed it so that in a trending environment, like we saw to the downside in February and March, we wanted to be able to capture huge winners. And we also wanted on the upside to capture the largest possible winners until there is a sign of the loss of momentum. And yes, that means that you have to systematically accept losses about 50% of the time, and they're part of the way it works. But the net bottom line result is that the total dollars that it puts up are far, far larger than if we were shooting for winning percentage, the highest possible winning percentage, or what some people, a lot of new people will ask me, it's like, what's your accuracy rate? What's your accuracy rate? What's your winning percentage? And that is not the question that leads to the most profitable algo. That is a question that would protect the person that's running the algo from too much pain psychologically, but it does not bring in the most bucks. So this is, by the way, I want to show the Dow Jones Industrial Average algo. This is probably the cleanest trading item for our algo, and I'll prove it to you when I show you a spreadsheet in a minute. So what the algo does is it has an adaptive moving average, Perry Kaufman's adaptive moving average, and the adaptive moving average has 3 different settings to it, and the third one is always 30. So I can back test it for the first 2 variables, and that's part of the back test, and this creates this moving average that moves, that constantly shows on the price on the chart. When that moving average is sloping to the upside, in other words, the most recent day, for instance, the most recent day today, the adaptive moving average closed slightly lower than it did the prior day, and that's why it is still this dark red color. If it closes slightly above, the adaptive moving average closes slightly above the prior day, then it's green. And long signals can only occur when that line is green, and short signals are the only type of signal that can occur when that line is red. That's the first piece of the puzzle on the algo. The second one is this indicator down here called WB-RSI3M3. This is actually a simple RSI using standard settings. And this Walter Bresser came up with this idea. He was one of the pioneers of technical analysis, computer-based technical analysis. He came up with this idea of smoothing the RSI, where you take a 3-period simple moving average of the RSI standard settings, and then you take a 3-period moving average of that moving average that you just created, and that's how you end up with this this black line here. It's actually a double smooth RSI. Then you apply a moving average over that. So I use the Walter Bresser settings the way he described them in his writings, and that never changes. I don't backtest anything associated with the internal parameters of that, but I do on the moving average of the Walter Bresser. So this moving average is a 10-period moving average, and that's based on backtesting. So I'll get to that. I'll read that question just a second. Let's see here. So when we go in and look at the strategy, we have some basic parameters. There's the parameters associated with the AMA, the adaptive moving average. There's the moving average of the Walter Bresser, and there's the stop loss amount. It's pretty much that simple. Now, I can complicate it a little bit more and get it to be more profitable by telling it, okay, I want to use a different size stop for the longs and the shorts. And then I always have it look at the last 3 years running, the most recent last 3 years running. So this would be June 30 of 2017 through June 30 of 2020. With all of my back tests on all of the algos are set for that range. And then another thing I can test is a trailing stop. Would it be beneficial to use a trailing stop? And in some items, it does come up with a trailing stop that actually brings a little bit more profitability to the algo. And in other items, it can't help. It just doesn't help. You know, it can't even bring in as much profit as it would without it. And the reason the trailing stop isn't really that necessary on this algo. And let me get this back to normal here. There we go. Is because the way that this has an open objective, it will show you loss of momentum when it sees it with a crossover on the Walter Bresser, and that's the exit signal. Now, sometimes we if we are using a trailing stop, and some of the items do use it, we'll have this little arrow that shows up, and it might show up 1 candle or 2 candles earlier before the exit signal, and that is a warning to change the stop to trailing. So you can see it stays in the trade until if it backtests better with a trailing stop than not, it'll tell you when to switch to a trailing stop. But until it sees, it either gets stopped out or sees one of these red blocks up here, or a green block for shorts, that's the get out. That's the get out signal. And those don't occur until there's enough of a loss of momentum that it's likely not going to continue higher. So that in a nutshell is how it works. Andrew's asking, you don't see many red filled boxes, losing trades on the chart. Those green filled profit boxes are rather large. Both shorts. Okay, that's not, that is my son, Andrew, who actually is the one that prepares the nightly reports for you every night, sends them out to you. And he's reminding me to point out to you that the big green blocks, what those mean is if the current settings were in place during the prior price action, those would have been winning trades. They would have got in long here, and it would have gotten out of the long position here. The red boxes are always going to be smaller in this with this algo than the average winner, because they are capped. The amount you can lose is capped by initially a fixed stop, and sometimes a trailing stop. And so I'm going to bring up the Sortable Excel spreadsheet, and this is something we're going to post it on a blog post for you, and you can all download this and play with this all you want. But this is also something Andrew worked up. So he took all of the stats from all of the different covered items in the premium plan, and it allows you to sort. So the ultimate item, I think, to sort is probably the return on investment. And what that does is it takes the account size required and compares that with the total net profit over a 3-year period of time. And you can see that, as is almost always the case with every quarter that we do this, Bitcoin ends up bringing in more the highest return on investment available of all the items that we show on our algo reports. One reason for that is that it has a higher volatility than just about anything else. And so when it gets into a trend, it can move fast in really huge amounts, and our algo is designed to capture a large chunk of those big swings when it gets them. But I'd like for you to look at other aspects of that. So one problem with Bitcoin is, at one point in the last 5 years, you had to put up with 7 consecutive losses on it. That would be hard to swallow. And so let's sort smallest to largest on consecutive losses. So this is basically saying, when you sort this way, you're saying, show me one that I actually could deal with in reality. How many consecutive losses could you as a person put up with and before you threw in the towel on this thing? It's important, and you have to know that about yourself. How many consecutive losses would you be willing to deal with? And you notice that there's a couple of items that had only 3 consecutive losses during the back test, but their return on investment was just so-so. But look at the Dow Jones Industrial Average. Even with a 53% win percentage, it would start with an account size of $12,202 based on the back test, and bring in $91,300 worth of profits, a 748% return on investment. And during the entire 3 years, had the current settings been in place during those 3 years, the maximum number of consecutive losses at any point would have been 4. It's very consistent. And at one point it had 5 winners in a row. So during probably that 4 consecutive loss period, yeah, there was a drawdown of $7,182. So the drawdowns are always going to be, there's always going to be a number there. That means if during the consecutive loss period, how far from your high water mark did the account draw down at its maximum dollars drawdown? And some items like crude oil, there was a pretty substantial maximum drawdown on that one. So what's another item besides the Dow Jones Industrial Average that worked pretty well? What if you have a small account? Well, thanks to the new MYM contract, which is basically the same as the Dow Jones Industrial Average YM futures contract, but instead of each tick or each point, Dow Jones Industrial Average point being worth $5, it's worth 1/10 of that, 50 cents. And so a person could, with a this says account size required $1,220. So a person could have traded the Dow Jones Industrial Average and if everything had worked out to the way the back test shows that it could have, starting with a $1,220 account, could bring in an additional $9,131 over a 3-year period. So the return on investment's the same, and the maximum drawdown at any point was only $718. And that is trading one contract at a time. So each one of these futures contracts assumes trading one contract at a time. Now, not all of these are futures contracts. Many of them here are ETFs. For instance, HDGE, this is a way to short the market. It's an ETF where you can buy shares, and what you're buying is an actively managed shorting system on particularly weak stocks. So these guys that manage that ETF, they're not shorting stocks like Apple, Microsoft, Google, and the like. They're not going to ever short stocks like that. They're going to short stocks like airlines and other things when the time is appropriate. And you can see the winning percentage there, almost 50%. Return on investment, 50%. Account size required $10,682. Best thing is there was only 3 consecutive losses during the back test. But here's the thing about that one. It's an ETF. And so on ETFs, we assume that when you enter into a trade, you're buying $10,000 worth of shares. $10,000 worth of shares. So I'll get back to the sortable spreadsheet later, possibly. But I want to talk about the current situation that we have in the market. And let's look at the S&P. On Monday, yesterday, there was a big up day in the market, right? Yeah, and I got, I know during the weekend webinar, I was generally bearish to this week. I was bearish this week and possibly week 10 days. And that's based on my Hurst and Elliott wave combined roadmaps and other cycle analysis that I've started adding in. And generally things look pretty bearish. As a matter of fact, I have a couple of screenshots. So what I'm going to talk about next is why it's important as a premium plan member that you stay in touch with what I'm predicting based on a number of factors. And all the things that go into developing my LA wave count, Fibonacci price targets, cycle analysis, and so on and so forth. But one of the things that I always am harping on is sentiment. And you'll notice on the S&P yesterday, there's yesterday's candle, and I put a pink line here on this. The DSI, Daily Sentiment Index, hit a 91. It hit a 91 yesterday. So that's the same as what it hit right here. And that was followed by what looks like on a shorter term chart, a 5-wave down structure. And if you go back to the last time we saw a reading of 91 or greater, it was a 92 right here, and that was on January 16 of this year, which actually was the top in some indices. Some indices had a January top, other ones had a February top, and in the Dow, it looks almost to the naked eye like a double top. And so there was a 92 reading, and while it kind of hovered there for a few more days, it did work its way lower next. And it just managed to barely eke out a new high before getting crushed starting in mid-February. So what the daily sentiment index is that's the percentage of retail traders that are bullish. And anytime you get into that kind of extreme, like up into above 90, that's dangerous territory, because all of the retail traders, almost all of them, feel like that there's no stopping this market. It's going to continue higher. They're so bullish, they're all in, and there's really nothing left to happen to them other than to get crushed. They can't buy anymore. I can tell you there's the savvy traders always look at sentiment, and whenever sentiment is too high on the DSI, the retail sentiment, they refuse to buy. They're looking a lot more to short right there. And so I developed the algo so that way as well. So on the S&P ES futures contract, I back test. So on any item where the DSI is an available stat, that would be the ES contract, the NQ contract for the NASDAQ, and other, on commodities, it's available on almost all of them: gold, silver, crude oil. But I back test, and I'd look for a threshold. And what that threshold basically does, it looks back over the last 3 years, and it's basically looks, what is the highest DSI reading that you could still buy at, and the odds would still be with you that you would put up some profits. And the back test brought back a level of 87. So anytime the DSI on the ES contract is above 87, the algo will refuse to buy. And on selling, anytime the DSI, based on backtesting the last 2 years, anytime the DSI is below 12, it refuses to sell and to short it any further, because the odds just aren't with it that it would make money. For instance, I'm going to run a back test right now on the high threshold number, and you can see that if you don't take any new long positions, if the DSI is above $87,000 on the ES contract, the algo, with all the other settings being what we ended up with, we bring in $84,000 in profit over 3 years. But you can see that if we set that at a 97, or that it would only be able to bring in 26,000. So this is huge, that it not take any new long positions if the DSI is above 87. And that is a back tested number. Same thing with the short number. If we back test on that one, You can see that it can bring in 84,000 based on current settings over the last 3 years. If it doesn't take any new shorts, if the DSI is below 12, but if we hung out and kept shorting it all the way down to where the DSI was maybe a 4, then that would have lopped off about $7,000 worth of the total profit that was made over the 3-year period. So what just happened is with a 91 DSI yesterday at the close, it got a buy signal. It got a momentum buy signal. The adaptive moving average had turned green. We were on a green crossover on the Walter Bressett, so all the necessary things were in place to take a new buy signal, except the DSI was too high, so that the algo refused to take it. And then today we got a sell signal, and this sell signal right here, I think, might be a real good one, because we're just off of that really elevated DSI of a 91. And then based on my other work using Hurst cycle analysis and other cycle analysis, the composite line on a no repins analysis of the S&P since starting in 1950 is bearish down into August. And then it's bullish up into the election. So this plunge that we get down into August, you know, I think we're this market. This is saying this market is going to be weak. The composite line says down into early August, but notice the size of this nest down here on Hurst cycle analysis, and it could be bearish all the way down into late August. It could stay bearish that long, and then likely move up into the election period, where the nest is actually an early, the 40-week cycle peak nest is in early November, about the time of the election. And so there's a very simplified view of what Hurst is basically telling me on what's going to happen. You know, the general cyclic direction that is expected next, basically through the late in the year. I have a new model that I'm using that's at the foundation of for the study of cycles for members there. It's only $100 a year to get an annual subscription. To the website there is cycles.org. I make nothing if you subscribe, other than maybe get a smarter and more well-informed customer about how cycles work. But cycles.org, so you can join. It's only $100 a year, and when you join, you gain access to a cycle scanner. And so these next two screenshots I'm going to show you, I developed with the cycle scanner, and the way I use the cycle scanner at the FSC site is as kind of a confirmation. I'd like to see some confirmation that Hurst cycle analysis is correct. And you can see that the composite line, if I use have the analysis look at the 10 strongest cycles operating in the market right now that it can find, and there are all kinds of different lengths of days and things. The composite line is bearish from July 7 through October 8. But the beautiful thing about that software at the FSC site is that it also can tell you which cycle is the most dominant of all the cycles, which cycle is operating, has done the best job of hugging up into price and coming very close to the peaks and the troughs going back X amount of period of time. And on this one, the dominant cycle has been projecting downward movement from the middle of June down into late August. So that is pretty much a perfect match to Hurst cycle analysis. It's been looking for a 20-week cycle peak in this neighborhood here, and then a movement down into a large cycle trough. So the inertia pulling down into this large cycle trough could be significant. I also simplified that use of that model, and I only used on this one the strongest, most accurate cycle that was found, and that would be the dominant cycle, 132 days, and the strongest one using a kind of a cyclic mathematical method using Bartel's. So only 2 different cycles were considered on this composite line, which takes an average of the two, and it's bearish from about now down into September. And if we look at what the dominant cycle is saying here, it's bearish from middle of June down to late August. So all of this was basically telling the same story, and that is, if you're looking for a sell signal that would be that would match up well with my other work, this one matches up well using about every measure you can imagine. Sentiment, the cycles, 2 different methods for using cycles. How about delta volume? I also show that once in a while on my during my weekly counts webinars. And this move down today, these green little circled things is showing where the delta volume, the buying was particularly weak toward the end of an upswing, and it shows where it weakened on downswings as well. And this move that we saw today to the downside, it showed us the highest delta, or that would be selling volume using limit orders. So that kind of eliminates the retail trader to some degree from the volume statistics, and lets you know what the big boys are doing and what their algos are doing. They're basically using limit orders, and that's that negative 15 delta is the largest kickoff selling delta since this delta of negative 15 right here, and that was basically followed by a very solid move to the downside. So even delta volume is showing some bearishness here. What else is showing bearishness? I showed this in the weekend webinar. It shows how the equal weighted S&P 500 is lagging terribly the market cap weighted S&P 500 ever since June 8. So that essentially means that the market is exhibiting bad breadth. Since June 8, and then I took this screenshot yesterday at the close, the equal weighted S&P was down 8.25% since June 8, but the market cap weighted, which the 5 largest market cap items in the S&P 500 are Microsoft, Google, Facebook, Apple, and Amazon. It was only down 1.8%. So this means that the very few stocks are holding this market up at this time. So that is also a bearish sign. So there's a lot of things running against this market. And if you tune into financial propaganda TV, they'll talk about how, but the Fed's got Fed's got this market's back, right? Fed's got its back. Well, let me ask you a question. I'll just send out just a quick poll. Don't feel free to answer in the chat. When do you think the Fed most recently started QE? In what month do you think the Fed most recently, over the, during this last year or so? And I think most people would say March, at the bottom of the market. But that would not be correct. The Fed actually started QE in October of last year. So and the reason was because of a problem that was showing up in the banking system associated with the repo market. Remember that? So the Fed was already printing in order to prop up a sick repo market starting in October, and they were doing that systematically. And so they were already in QE when we got the 38% plunge from mid-February to mid-March. So does that mean the Fed really does have the markets back? And if they do, then why did they allow it to drop 38%? If they can micromanage this market, why didn't they just stop that right in its tracks? They were already printing. And so how much have they printed so far? This article is a little old now. It's from May 13 of 2020, but they are projecting to print about 3.5 trillion. I think it'll go well beyond that. In an attempt to help prop up the alien economy during the COVID pandemic. Of course, all of the media says all of this is 100% about COVID. It's all about COVID. So if we can, if we can get a antidote or some kind of miracle drug that would solve this thing, then the market would just take off like a rocket. Really? If that's true, then why was this? Why were we starting to see enough trouble in the markets that the Fed started QE while we were still at or very close to all-time highs? So I really think, and what we're seeing right now is we're seeing a lot of propaganda thrown our way about how the Fed's got this things back, and how the market is able to disconnect itself from earnings and the economy, and that's the only reason they can come up with for why it has disconnected. But the actual reason I think the market has disconnected from the economy is because the market doesn't run on news. It runs on cycles and other technical aspects. And so everything that I'm looking at right now, every last technical aspect is bearish. So we'll see if they can manage to prop this thing up. Things really don't look very good between now and sometime in August, and then it's projecting this enormous rebound. And that's why on the S&P, my count, wave count, is that this easily could have been a wave 1 or A, and now we're getting an A, B, C. So it could be that this down move that we see is only just a B wave to the downside from an Elliott wave standpoint. But still, this sell signal we just got today is an interesting one. It has a lot of components to it that are would suggest that this market likely to move down into August. Let's look at a couple other things on the signals. Why don't we look at gold? Gold managed to sneak up, make a new high today. And I think I have, yeah. So this is a live chart on the GC futures contract on gold, 240-minute chart. And you can see I've had this target up here for wave B. There was 1812.40. And I thought that that gold had moved high enough back over here that it came so close to that high that must be the top. But it managed to work its way higher. I'm counting this as a triangle and a final thrust out of a triangle. And the top tick today was 1810.80. 1810.80. So that is $1.60 per ounce off of that target. Still not quite able to quite reach it. I think we have the market at kind of a critical juncture. Let's see what the algo is saying. Once again, on gold, we have an extreme setup on the DSI, the positioning of these on the sentiment. I'm getting these so they match everything else. And notice that I was showing the DSI on this chart, and the DSI today, or at the close today, was a 91 on gold. Well, that's the highest reading on gold DSI since this 96 back here. And let's see what back testing says. And yes, gold did spike to one more new high after that, and then saw some downward movement there after that. So I only had one more day of a new high after 91. But back over here, we have we first saw a pretty rich reading back here. Of a 90. So let's look at the back testing and see what it says about the thresholds, and based on the 3-year back test, if the DSI is above 84, this algo will not take any new long signals, because on balance it has not been a profitable thing to do. And 14 is the threshold at the bottom. So do you see all these red boxes up here? Red boxes? That means that the DSI was too high at the close for the for it to take the new buy signal. So now we've seen this twice in a row, including today on gold, where the DSI was so rich that the odds are taking a new buy signal at the close, at the open of today's new futures candle. The algo refused to do it. So this is based on back testing. This isn't based on, oh, I don't think, it's a good idea. This is based on back testing, and 84 is the number. So it would close above 84. So June 30 and July 7. Buy signals were skipped because the DSI was too high. So the algo is still flat. So how did this this algo do? And I already showed you on the July sortable spreadsheet that it actually is one of the better. The algo signals coming on gold is one of the better items. So here's gold. 83 trades over the last 3 years, 46 winners, 37 losers. That's a pretty good winning percentage for my algo. Winning percentage of 55%. It brought in $73,351 over in profit over 3 years and started with an account size of about $16,000. That's a 460% return on investment. Also, very importantly, the most consecutive winners was 7, the most consecutive losers was 4. So that's pretty livable. So the algo has done a good job on silver, and it's still refusing to take these new long signals. And we have the Walter Bressert that's in bearish shape. And the question came in, oh, but you know, on the chat from Chris, silver's very close to invalidating my wave count. So this is a really good question. I'm glad you brought it up, Chris. I used to, back when I was just a pure Elliott wave counter, many years ago now, if a wave count was invalidated, then I was afraid that what that meant was the price was just going to take off and rip roar from there. And that, you know, that old wave count was no good. I'm going to have to come up with a bullish wave count. But that was then, and this is now. And now I have cycle analysis at my side. And you can see that Hurst cycle analysis is bearish from July 1 down through August 4. And then the analysis at the Foundation for Study of Cycles is also bearish from July 9 through July 31. So even if my wave count was invalidated here, I would still be bearish because of the cycles down through late July, early August next. I re-optimize the algos once a quarter, Chris. So let's look and see if we are in a kind of a similar situation with silver on sentiment. And the answer is yes. You know, so we are at a particular juncture in the markets where a number of items are extremely, extremely stretched. Let me see if these 14 and 86, yeah, are the numbers 14 and 86. So isn't this interesting that all during on silver, all during this period right here, the DSI has been extremely high. It's been above the threshold where it could take a new buy signal. So all during this, pretty much, you see these little red open boxes around the candles. That means that if there's a new buy signal during that candle, it refuses to take it, and it refused to take the one that occurred on July 6th, but for that very reason, because the DSI on that day was 89. And it's just well against the odds that the silver would break out and just rip higher here, not with that kind of elevated DSI. Not to mention, and the thing that kind of makes it really interesting that the DSI was that elevated during this period is a price stayed below this high that actually occurred back on June 1, all during that kind of sideways move. So I don't see, but the algo doesn't see this as a bullish enough situation to actually enter into a new buy signal on silver either right now. And it didn't care. It didn't care about Elliott wave invalidations at all. So anybody want to look at anything else? How about crude oil? Got a number of people interested in crude oil these days. We're almost an hour in. I'll just flash the chart on crude oil, and we're going to make the sortable Excel spreadsheet available to all of you, and anyone asks for it, whether they're a subscriber or not, so they can take it in Excel format and sort it around and look at it. Just a friendly reminder before we look at crude oil. Yeah, here's the adaptive or the AMA algo. I call it the AMA algo. It's still on a buy since July 1, but it's concerning this divergence that it's getting, and it's in a very narrow pattern across here. And you can see that Walter Bressert is making lower highs every time, going all the way back to its high point during this big winning trade here. As far as sentiment, you know, every night you get a screenshot on sentiment screenshot on everything as well. And, you know, the DSI was as high as in the low 80s back here, 78 here. Let's see what the threshold is on the DSI here. It's 13 and an 84. 13 and an 84. So we haven't seen an 84 yet on the DSI. We have seen an 83, it's very close. And we've gone through a sideways period here where the commercials were heavily short. I don't know if this, I'm going to turn off the streaming because the stream, when the streaming's on, you don't necessarily get a good reading on the commercials percent of open interest. That's the reason we always take our nightly screenshots for you with the streaming off. So a little bit of a jump here in commercials as a percent of open interest, but still the commercials are still about as short as they have been at any point. They're about as bearishly positioned as they have been at any point in the last 6 months right now. Slightly off of that extreme, but not much on the 6-month look back. So, you know, we don't really have anything conclusive that's keeping the algo from buying here. It is on a buy from July 1, but the crude oil has almost gone nowhere since then. And I think it looks pretty weak when you look at a 60-minute chart on crude oil. I'm counting a 5-wave down structure from the June 23 high, and then this move up, in my opinion, is clearly corrective. And I'm counting this as likely a maybe a leading expanding diagonal 1, 2, 3, 4, and then a 5th wave down here, and then a deep retracement. So I think it's likely to chop sideways and a little bit lower crude oil until it finally breaks into a wave 3, I think, to the downside, possibly a wave 3 of 3, based on this count later in the week. A friendly reminder about the way our nightly reports come out to you. On our nightly reports, I update this is an example of what you get, what subscribers get every night from us, is not only the screenshots of each algo, as well as each item, the sentiment conditions on each item. So there's a good 40 screenshots you get every night, plus you get this summary spreadsheet. and it has color-coded trade management items. So this is the one from yesterday, and so there was an exit. So DIG is the 2 times bullish large cap oil companies ETF. It was in a long trade from June 2, and last night it said, "No, get out of it. It's lost any momentum to the upside." Actually, yeah. And gold miners, it actually suggested exiting the trade yesterday. The gold miners were up a bit today, but actually gave up a lot of their gains late in the day. China 25. So some of these are ETFs. We don't have much time left. There was a sell signal on the US dollar yesterday, but then the US dollar actually today, I think, rebounded. Midday started to rebound. Is there any interest in me talking about how to set your stops on ETFs? That seems to be an area of where there's a lot of questions from time to time about that, and I could cover that here toward the end. On the US dollar index, yeah. See, this count of a bullish 1212 is actually still alive on the US dollar index, and it would make sense that US dollar index would move to the upside here if we're going to see a risk off environment, which is exactly what I think we're going to get. So I think the dollar might be ready to kind of break out some to the upside. We'll see if that occurs. It's been very sluggish to get going, but this could be actually very bullish. A 1 expanded flat for 2, another 1 and a 2 could be very bullish. And I have some cycle analysis, like here's one on the Euro USD from July 1, and it's the cycle analysis tool at the Foundation for Study of Cycles is bearish on the euro against the dollar all the way down into at least August and maybe September, and it's bearish now. So bearish euro means stronger dollar. The question that some would like to see would be how to figure your initial stop on an ETF. So I'm going to pick an ETF item. Let's see here. But just for fun, we'll pick one of the bonds items. We haven't looked at bonds yet. And I want to point out at my website, there's an excellent resource document in the guides. So you click on resources and go to guides, and it's the guide number 4, Setting Protective Stops, a guide for Elliott Wave Plus subscribers. And this gives you step-by-step instructions on how to set a stop for a futures contract, how the trailing stop works, and also how to set a stop on an ETF. So here's an example of an ETF trade that uses a trailing stop. Here's so everything is in here that describes how to figure out your stop, and so that document is available to you. And I'm now on these. So let's look at UBT. UBT. This is the 2 times bullish bonds ETF, and it got a buy signal on June 17th. Okay, And so what happens is you get a screenshot that says, okay, when you get a buy signal on June 17th, the evening of June 17 on an ETF, it says buy at market $10,000 worth of shares first thing in the morning when the market opens. So this item opened at 130.49. So we've got a buy at 130.49. All right. So the question is, how many shares would you buy if you were just going to follow the rules of the ETF exactly? Now, you don't have to buy exactly that number of shares. You could buy twice that number, or 3 times, or 4 times that number, or you could buy 1/10 that number. You just have to figure out the math the rest of the way. But what we're going to do right now is figure out what was the original stop on this trade if it bought at 130.49. So we're going to bring over a calculator, and we're going to buy $10,000 worth of shares, and at 130.49 per share, and what we bought was 76.63 shares. Everyone understand how I got to that? 76, and I'm going to use the decimal points just to be super exact here. 63 shares bought equals 10K. Okay, so 10K, I'm going to buy 10K worth of these shares at the open. The open is at 130.50, and that is right here. So there's, I'm going to maybe expand this a little bit so you can see it a little more. So the buy signal came in here. The email went out. It's telling you that check for signals. You check the signals. The market's closed, and you put in an order to buy 76.63 shares at the open, or something very close to that. Now, so what do you have then? You have $10,000 invested in this item. So the rules say that your fixed stop is $200. So I'm going to bring the calculator back over. And if you had a $10,000 investment and you lost $200, what would the shares be worth then? They'd be worth $9,800. And so you divide that what they would be worth at the maximum loss by the number of shares you bought, 76.63, and this is going to be our stop level, 127.88, basically 89, 127.89. That is our stop. It's that easy. So that's how you figure out on an ETF where your stop would be when you buy at market. Did everyone follow that? So you buy $10,000 worth of shares at the open. You look at how much the dollar value of the fixed stop is. You take 10,000 minus that amount to find out what your shares would be worth at the stop level, and then you divide it by the number of shares you bought. And that's how you come up with your stop. Now, when you get a signal on an ETF, that first night, it doesn't tell you what the stop is. And the reason is we can't take these screenshots with the streaming running, because it screws with the accuracy of the sentiment readings on the percent of open interest sentiment readings on the sentiment charts if we have the streaming running. Let me see if we, Andrew, are you still in the room? Did we get any buy signals on tonight's edition on any ETFs? Hoping Andrew's still in the room. Did we get any buy signals on any ETFs? I can actually check. I'll go to the site. And I think he posted this already, nightly reports, premium plan and nightly algo reports. We'll go there. And here's the nightly report. By the way, if you want to download all of this all at once, use this link right here. That'll allow you to download the entire edition in a zip file and store it on your hard drive. That's how you get that. You do that. You go to this alternate link right here, and then you select download. Because I'm logged in at my own OneDrive, I have a lot of other things I can do here, but when you go to that link, it'll only give you one option up here, and that's download. So we're going to look at the nightly report tonight, and we're going to look for an ETF. Okay. A new buy signal on an ETF. Okay, here we go. Buy signal on SKF just happened. All right. So we're going to go to SKF. This is financial sector. So on SKF, look, there's our buy signal, and that came in. So that's a new signal, July 7. So this is what tonight's screenshot would look like on SKF. And what it's suggesting is to go short the financials at the open, $10,000 worth of SKF shares. Well, let's say SKF opens in the morning exactly where it closed, and it closed at 1293. 1293. Let's do this the easy way. Let's say it opens at $13. So it opens in the morning. Yeah, 13 bucks. So how many shares would you buy if you're buying $10,000 worth of shares divided by $13 is you would buy 769.23 shares. Did that say 769.23? I think it did. 10,000 divided by $13 a share, 769.23. So that's the number of shares you're going to buy in the morning at the open, if it opens at $13. This says a fixed stop is at $500. So if you take $10,000 investment, if you were going to move all the way down to the stop, that investment would then be worth $9,500. And you divide that by the number of shares that you own, 769.23, and this is going to be your stop, 12.35. So there's your stop. Now, at some point, let's say it takes off and bonds or financials take off to the downside, and you get some into profit here on this thing. And then let's say you get, like, see this buy signal right here? A few candles in, it got one of these little red arrows, and let's say we instructed you to change the stop to trailing. Well, you can figure out that yourself if you want to, based on the document I sent, but at that point, the stop after the first day, the size of the stop is going to show for you. The size of the stop is going to show for you on the screen. I'm looking for an ETF that is currently in a trade that I can show you how it'll show you where the stop is. And okay, the China 25 ETF is on a buy signal 7.6 from 7.6. Let me get rid of this stuff. And this is going to be my final thing I'll show you tonight. So we're going to finish this thing up here. But this China ETF, it had a huge gap up. And you can see that we're 1 day into the trade now, and it's telling you exactly where the stop is. It's at 64.32. So it bought at the open of the candle after the daily candle. This is an ETF. So it bought right here. And the sell stop is just $500 stop on this item, and it's not too far below that. So this opened at so that's a fairly tight stop, and I almost guarantee you when you get that big of a gap on an ETF, it's probably going to get stopped out as it fills the gap the next day. So this is another thing you kind of learn over time is on these signals. These are automated signals. If it gives you a buy signal after a huge gap like that, I wouldn't buy at market the next day. Even if you're interested in buying the item, I'd let it come in, maybe attempt to fill that gap before buying in that situation. So that's just something that is very typical that would happen next. Not to mention, when you look at my roadmap on the Hang Seng, it's not necessarily immediately bullish right from here. It's probably going to pull back down into August, in my opinion, just like the U.S. stock market probably is, based on cycles work. Any other questions? I hope this has been an informative webinar for you, and many of you, I think, are active premium plan subscribers, and for you guys, thank you. I really appreciate it. Andrew, my son, who prepares the reports for you, very much appreciates your subscription, and I hope this helps you navigate your way around inside the premium plan. If you aren't a premium plan subscriber, but you subscribe to one of my other levels of service, you want to upgrade, you can do that in your back office by logging in and look at your subscriptions from your dashboard, and there should be a upgrade button there. If you have any trouble upgrading and you want me to help you do that, I will try to do that from here. Send me an email. If you've never subscribed to any of these services before and you want to give it a shot, send me an email, ask me any questions you need to ask about our services. I'd be glad to get back with you. Yes, we will post the recording. Probably, it may not be tonight. It might be probably tomorrow morning, yeah, probably tomorrow. The recording will go up. If you have any questions about anything, you can email me. My name is Sid, and my email is sid@elliottwaveplus.com. Have a great evening, and happy trading. We'll see you soon. Bye-bye.